The cost of buying a home took another leap this week, as the average rate on the popular 30-year fixed-rate mortgage surpassed 7% for the first time since 2002. It was just last month that rates climbed above 6% for the first time in 14 years. The latest dramatic jump makes a home purchase even more unaffordable and stands to further slow a market already reeling from the rising borrowing costs. "It's crazy," said Tressa Pope, a Los Angeles area mortgage broker. Rates rose so rapidly that people weren't prepared. Only in the early 1980s, another time of high inflation, did rates rise quicker than they have in recent months. Although rates are still below the historical average of 7.76%, it's the sudden change that's upending the market. For much of the pandemic, the Federal Reserve's easy money policies held mortgage interest rates below 3% and enabled people to make larger and larger offers. Southern California home prices rose nearly 40% in 2 years. Pandemic boom towns such as Boise, Idaho, and Phoenix saw larger gains. But this year, inflation and the central bank's efforts to tame it have caused rates to more than double. With rates rising so quickly, buyers have had to try to buy homes with values set when money was cheap. Many can't. Home sales are plunging across the country and, in some markets, prices are falling, but nowhere near fast enough to balance out the rising interest rates. In Southern California, prices are now nearly 6% off their peak in May, according to Zillow. In Los Angeles County specifically, the typical home value, which Zillow defines as the average of the middle third of the market, was $835,546 in September, 7% below the peak. On Thursday, mortgage firm Freddie Mac reported that the average cost on a 30-year fixed-rate home loan was 7.08% this week, up from 6.